So it's early March and markets are moving quite dramatically. There's a lot of turmoil again in financial markets. We're seeing big moves, 5% swings in equities, bigger swings than that in some commodities. And I think it's a really good time for me to go over one of my favorite issues, which is obviously technical analysis. And again, hopefully I'm just trying to persuade people why the underlying assumptions behind technical analysis, may not be valid, and why we see such a huge failure rate of technical analysis traders. And we do. Okay, that is undeniable. There is a massive failure rate among technical analysis traders. So if you look at markets on a chart, it doesn't matter what the conditions are, markets look pretty much the same. Okay, all you have in volatile times, you'll have bigger bars or bigger candlesticks or slightly different ones, but the reality is that in terms of your lines and your levels and all that, they basically work the same way. If you're involved in markets, and my whole experience has been based certainly in my first 15-16 years in the industry of being market making. When you're involved in that side of things, you see things very differently, and that's why I don't believe in the assumptions of technical analysis. Now, right now, for example, if you're trading futures using a DOM, a depth of market, and you're more of a scalper or intraday trader, but you're using that method of watching markets, you see a very different picture to someone who's looking at a chart. And in my opinion, you're seeing a much better picture, a much more realistic picture. If you look at the liquidity of futures markets right now, whether it's the ES or even the ones that are usually quite illiquid, but even right now the E-mini S&P futures, they are very illiquid. Okay, there's very little on bids and offers. Liquidity has dropped to levels we really only see in times like this, but they're very low. Another factor, if we add to that at times of high volatility, is we tend to get more orders coming in as market orders into futures markets. The reason being because if you leave limit orders in, there's a very high chance that they won't get traded. And if someone wants to do something, they just need to execute. So we tend to get a higher percentage of market orders just coming in, hitting the market. And if you add together those conditions of more market orders coming into the market and lower liquidity, you get obviously even further increases in volatility. So those two things together, they all help to contribute, and this is all part of the reason why we get extra volatility. So if we look at that, and you were looking at the markets, intraday, someone could sell 50 lots, 100 lots now, and it actually can move the market, whereas 2 or 3 years ago a 100 lot order was a nothing order. So what I want to come back to now is the fact that intraday markets will create highs, lows, and going forward, in whether it's either today or in future days, the technical analysts will use that and talk about it bounced off of a level, it rejected this level or whatever. Realistically, if you look at the liquidity that's taking place and the way the orders are happening, remember, market orders hitting into thin liquidity means basically a lot of randomness of price levels. The price that's created, remember, is not being created by someone wanting to buy necessarily there or selling. They're doing it as a market order. So market orders are being matched on both sides, really. So there's a lot more randomness behind these prices. And sure, there's going to create a low of the day and a high of the day. There's always going to be a low created and a high created. Does it mean that that's where the buyers came in and started buying it? Not always, particularly not in these more volatile times. And this is where I think those people that watch the markets more closely and more, in my personal experience, more professionally, they will not use those levels and say, oh yeah, the market turned off those levels. They're not going to come up with that conclusion. On a chart, you'll look at it and you can come up with that conclusion. Why? Because you didn't see it happen. And here's the thing. With technical analysis, you say that all that's important is the price that was created. You basically ignore context, and what you say is the way it was created, the manner it was created, is not important. And having been in this industry for a long time and having been a market maker for a long time, I have a complete disagreement with that. The way it was created is important. If you want to say that there was actual buying at that level, you should investigate whether there was or whether it just traded a 2 lot on the back of a market order. Okay, because otherwise your analysis going forward is going to be based on something that's really flawed, and in my opinion it is really flawed to be using these levels. So I think it's a really good time to have a think about that, and aside from whether X person makes money from TA or X person doesn't make money, I want to try and get the discussion going on, let's have a look at the assumption behind it. can we just assume that the low of the day was where people decided to rush in and buy? Or did it just trade a two-lot as part of a small market sell order? And if you knew that, would you treat that level differently? What if there was just, only 100 or 150 lots traded within the last 10 ticks of the low of the day because it was so thin? And that was all part of market orders taking place, so no one was picking levels. If that happened, would you still use that level? And if the answer is yes, well, basically what you're saying is you just want a simple solution. I just need something simple. So the TA people I know, because it comes up on my Twitter feed every day, they're still drawing their lines, they're still drawing, this is, it's going to bounce off here and there. That's not happening at the moment. It's market orders, people panicking, just get me out. That's what's going on. The idea of that people are rationally making decisions right now, well, it's not happening. There's a lot of market orders, there's thin liquidity, you put all that together, and if you try to analyze that, other than saying basically there's a whole lot of randomness going on, I think you're going to be misjudging things going forward. And of course, in weeks and months to come, whatever the low that's created here or highs or whatever, they're going to turn around. And similarly this morning, over this weekend that I'm recording this, there's been this announcement of the breakup of OPEC and Russia, and the oil price has fallen. Now, if you look at it on a chart, people might say things like, it rejected this price or whatever, but it didn't reject a price, it's reacted to news, okay? And going forward in 6 months' time, people may have forgotten, exactly the circumstances and the context, so that's when they start drawing their lines and all the rest of it with TA. But context is important. In my first book, Technical Analysis and the Active Trader, I give the example of the 2002 speed skating as a great example of the failings of technical analysis. So in 2002 speed skating, an Australian speed skater, he won the race, okay? And Stephen Bradbury, he became very famous around the world, and particularly here in Australia. There were, I can't remember how many skaters, there may have been 4, 5 or 6 in the final, and the Australian Bradbury was in last place pretty much the whole way, and coming into about the last lap, the other racers in the race, they all fell over, or 1 or 2 fell, and everybody tripped up, okay? And he ran around the outside, or skated around the outside, and won the race. Okay, now my point on this is that if that race was being run the next day, and you were to ask people, okay, who do you think's going to win? Somebody who watched the race might come up with a very different answer to that question than someone that just saw the result. If you just saw the result, you would see Stephen Bradbury won and whoever else ended up getting up and finishing second, third and fourth, and you would then make the assumption that Stephen Bradbury was the best skater on the day. If you watched the race, you would have a completely different conclusion. You would say, well, actually he was in last place the whole time and only won because everybody else fell over. That's a huge difference, right? That's the difference between watching something on a chart and watching it actually trade. And that's why professionals and people that actually watch the markets as they happen can come to very different conclusions. If you just watch the market on a chart, you see effectively that Stephen Bradbury won the race and you assume that he must have been the best skater in the game, right? Which is not what happened. If you watch it and you say, oh, it must have bounced off that level, if you watch it on a chart. But if you actually trade it and you watch it properly through a DOM, or you just do that extra bit of legwork and figure out what actually happened, you can come up with a different conclusion. So that's really the idea I want to put out there again today. I'll talk about this in my first book. I don't just slate technical analysis for the sake of it. There are real reasons based on experience and really just looking at the assumptions that lie behind it that I really want to get that discussion going, and perhaps from that you'll realize that these levels, they're just rules of thumb, not even that, but if you're setting your trading skills by them and your stops and profits based on those things, I think you're being misguided.